Hello and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that will move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. Stocks rally today with big tech leading the way. We'll have all the market moves you need to know. An American-made clothing company is weathering tariff turmoil. We'll talk to the CEO of American Giant on how that company is navigating. And American biopharmaceutical company Gilead Sciences reporting earnings. We'll have a special report on what those numbers mean. But first, we start with stocks closing higher as Wall Street digests tariff developments and earning results. Yahoo Finance's Alexander Canal joins us now with the trading day takeaways. Hi, Ali.
Hey, Julie. Well, the rally party continues the third straight session of gains following that brutal sell-off that we saw on Monday. This comes on the heels of some trade talk confusion from the White House, although generally a more positive tone for future trade deals. Also, some Fed speak helping to lift markets higher today, which we'll get to in just a minute. But let's look at the three-day trading action, because that's what really has stuck out to me, particularly when we think about the NASDAQ composite. Over the past 3 days, we are up about 8% there. S&P 500 follows at 5%, actually 6.3%. And then the Dow Jones Industrial Average is the one that's up around 5%. But going back to the NASDAQ, we saw a lot of those mega cap names really helping to lift a lot of what we've been seeing. And if we go to a heat map and check under the hood, you'll see names like NVIDIA, Tesla, Alphabet, all those Mag 7 players really just killing it today. I mean, Tesla didn't do much in after-hours trading after its earnings release, but then once we heard on the earnings call that Elon Musk will be foregoing his Doge duties, returning to the company, we saw stocks boom. And then here you have, over a 3-day period, we are up around 14% there. And then Netflix, I also want to give a shout out to, hitting an all-time high today. This is one company where analysts have debated whether or not we could see a potential stock split in the future. Rich Greenfield from Lightshed Partners also had a new note out today questioning whether or not Netflix could join the $1 trillion club. So another big tech company to watch. Now, I alluded to some of that Fed speak that we got, and to that point, we do have a bit of an easing bias on the side of the Fed, and because of those commentary, we are seeing the odds of a June rate cut tick up just a bit. This is the CME Fed Watch Tool projections. We're currently at around a 62% cut coming as soon as June. That's up slightly from the month prior, but we've heard from a lot of Wall Street analysts who have told us that the risks of growth to the downside, that's going to outweigh any potential inflation risks from tariffs. So we'll see if and when we get those rate cuts, but generally speaking, most economists think that they're coming at some point this year.
Right. Well, and Beth Hammack, the Cleveland Fed president, gave an interview today in which she said it doesn't feel like May they're not ready in May. They don't have the data that will support a cut happening just yet.
Right. So maybe June's the next one there. And also another action that I want to talk about is this Sell America trade that we've really been hearing over the past month. We did see some of those trends reverse, particularly when we talk about the 10-year Treasury yield. That is hovering at around 4.3%. We were about 4.4% throughout the week. And if we take a look at a month to date, you can really see some of the weird volatile swings since Trump's Liberation Day on April 9th. That has been a little bit confusing to strategists because typically we would see yields go lower as investors want to buy these U.S. bonds. But because of this potential Sell America trade, it's been a bit wonky, but we are down today. The dollar, though, it struggled a little bit. We are still below that critical, technical, psychological 100 level. We'll see if we can get back there. And then gold, that's just continued to soar, hitting record after record. We're not at the all-time highs, but we did tick up again as we're seeing global investors really want to search for these non-dollar denominated stores of currency.
Well, and that's really interesting that we saw it rise today. If you go to the intraday, so in other words, it was up today even as we were seeing the risk on rally come back. People were still maybe hedging a little bit, even with the gains that we saw in stocks.
Exactly, hedging, some de-risking. And I've been speaking to a lot of strategists about why we're seeing this potential weird move in yields. A lot of this has to do with the term premium, which is basically an uncertainty premium. There haven't really been any changes in consensus when we think about growth and inflation. So something to continue to watch, especially as we hear from Fed officials and see what they decide to do on interest rates.
Yeah, what else are you watching?
What else am I watching? The final thing is earnings, Julie. Julie, because, we've been hearing from a lot of these companies. We just heard from Intel. They warned about the macro, and it's not the only one. PepsiCo cut its annual profit outlook. American Airlines withdrew its full-year forecast. Merck lowered the earnings outlook. Tesla said it's going to be revisiting its full-year guidance in its second quarter update. So it just points to all the confusion that's happening on Wall Street right now. And as an investor, how are you going to be able to evaluate these companies if you don't even know what you're comparing it against, right? Comparing the financial results against. So I think it just goes to show how this tariff whiplash is bleeding into all these different companies, and the executives clearly don't know which direction to go to.
Not yet. Yes, we'll see when they do. Thanks so much. Appreciate it, Allie. Well, Gilead Sciences out with first quarter earnings. The shares are slipping about 3%. Yahoo Finance's Julie Hyman joining us now with the numbers. What stands out to you, Anj?
Well, definitely looking at Gilead in comparison to other pharmaceuticals which have already come out and reported. They did give us a beat on the numbers. Looking at the actual revenue, $6.67 billion coming in instead of the estimated 6.79. So that was actually a miss there. But then on the adjusted earnings per share, definitely got a beat there, 1.81 instead of 1.76. Looking at where they sort of lost versus gained, Gilead is known for, of course, its HIV portfolio, and that really carried the company through this first quarter. We saw in particular Biktarvy, that is one of its key blockbusters, up 7% this quarter with $3.1 billion in total sales, and that's a majority of the portfolio as well as a majority of the revenue that we saw for the quarter. Meanwhile, taking a look at, of course, the big thing that we want to talk about, tariffs, that is yet unknown. The company has been looking at what areas it could be impacted. What's important to note that Gilead already has a lot of focus on the U.S. We actually heard from CEO Daniel O'Day on the earnings call saying that, quote, the 27 tax reform was instrumental in the company bolstering their U.S. investment. And so Gilead is differentiated from its peers in that way, and that almost 100% of their R&D capital and infrastructure is in the U.S. That includes as well manufacturing, and they do have a lot of their IP as well here. So that's not something that is a key concern for Gilead. They are also looking to build out a little bit more, 2 facilities in particular that are already planned for build out through 2028. So that's where things stand for Gilead right now.
There's a deal, a potential deal in the pharmaceutical space we want to talk about as well. There's a company called Merck that is not our Merck.
Correct.
It is Germany's Merck KGaA, that according to the Wall Street Journal is maybe nearing a deal to buy an American company called SpringWorks for $3.5 billion. And SpringWorks shares went up sharply today on this report. What does SpringWorks have?
SpringWorks is an oncology company. I've actually spoken with the CEO in the past. So they have a good portfolio that's a match apparently with Merck KGaA's portfolio as well. What's really interesting about this deal and the reason why there's so much energy behind this is because it's a big deal in 2025. When we've been talking about repeatedly biotech on the decline, we've talked about how research and funding is really messing up things for biotech, as well as just general investor softness in this sector. And so this is why you're seeing that outsized move for SpringWorks and why it's such an interesting deal at such an interesting time.
And it's also interesting because the journal says that Merck, Germany's Merck, had previously said it was going to buy it, and then it seemed like it backed off.
Yeah.
So maybe now with all the market volatility, it's
a good time.
We'll see. We'll see if it gets confirmed this time.
That's right. They said it could be closing as early as Monday, so we'll have to stay tuned.
We'll see. Thanks, Anj. Appreciate it. Stick around. We got much more Asking for Trends still to come. This earnings season has been littered with companies cutting or abandoning growth targets because of uncertainty over tariffs. But for a company that makes all of its products in the U.S., there could be benefits. Joining us now, Bayard Winthrop, CEO of American Giant. Bayard, thank you so much for being here. American Giant is an American company that makes T-shirts and sweatshirts, other apparel, all in the U.S. So first, I guess I would just ask, have you seen an increase in demand because of having all of your products made here?
Yeah, I think that the general awareness and thoughtfulness about where products are coming from is helping our business in that way for sure.
And what about, we've been hearing from a lot of companies that are saying they're going to see increased costs because of the tariffs, particularly other apparel companies that are importing their products. So talk to me about your costs and what you have seen and what you think you will be seeing.
Well, there's no question that if the tariffs take anything like the shape that they're being talked about now, particularly in regards to China, that's going to increase costs for traditional apparel companies that are sourcing in China, Vietnam, and internationally. I think for us, when you make domestically, I think it is labor that you're really paying a differential on primarily. The sources of fabric and things like that are quite equal to our international competitors. But we think that's a good thing. We think that good quality jobs and communities that need them, particularly low skilled work, is a really critical piece that's been missing in the American economy. And I think that's why we chose to make our stuff predominantly in the U.S. And I think we pay a premium for that, but we think that's a good thing. So we transition to good quality, and I think the customers understand that.
It seems as though maybe some of your competitors will be raising prices as they see these increased costs. If competitors are raising prices, do you then see an opportunity to raise prices or the opposite?
No, I don't think so. I don't think that we really are going to respond to what our competitors are doing. I think we're pretty focused on our core business model, which is making really great quality stuff in the U.S. It's been that way for going on 15 years now, and we intend to continue to do that. And the gyrations that are happening in the marketplace, I think, aren't going to affect us very much. And so we plan on just staying the course. And hopefully some of this volume is going to come back to the U.S. and drive more energy into the domestic supply chain that really needs it. And I think we would benefit from that. So we're hopeful that that's going to result in more companies deciding to reshore domestically and bring some of their production closer to home.
Byron, I'm curious about something more of sort of a bigger picture question for you, or almost a cultural question. One of the things that Treasury Secretary Scott Bessent has said is that we need to wean Americans, I'm paraphrasing here, wean Americans off of buying cheap crap from overseas. And as somebody who makes both premium product that you sell directly, as well as making contract stuff for the likes of Walmart, do you think it is possible to see that kind of possible and or desirable to see that kind of cultural change where people buy less but maybe spend more on those few items that are going to last?
Yeah, I think what the Secretary is saying is actually maybe a little bit more nuanced than that. I think he's saying that the results of the policies of the last 40 years have resulted in a real addiction to cheap, disposable goods and a outsourcing of all our manufacturing capability, from textiles all the way through to warfighting ships, things like that, and that there's a real need to rebalance our economy and the Chinese economy, that the Chinese economy has really tilted too far away from a consumption-based economy, too much towards a manufacturing and exporting-based economy, and the U.S. economy really has become too overextended as a purely consumption-based economy. That may not be the best thing for your viewership that are very fixated on the performance of the stock market, but I do think the Secretary has said quite clearly that he believes that the U.S. economy needs to reclaim some of its manufacturing capabilities. I think that will address the question you're talking about, this addiction to cheapness that really, I think, all Americans kind of intuitively understand, that a lot of the things that we buy are quite different than they were 30 years ago when things lasted for a longer period of time. They were less disposable, better for the environment, arguably. So I think that's an ancillary impact from what the core intent of the policy that they're trying to enact is.
Byron, from a very big sort of existential question to a more fun one, you guys have partnered with Jason Kelsey for his clothing line. How did that partnership come about, and how's it doing so far?
Well, if you know anything about Jason, he's a solid, authentic guy that believes in a core set of values. He has a foundation called Underdog that benefits kids in Philadelphia and beyond. And he felt that it mattered a lot to him and his value system that he made his clothes locally. And it's not the easiest thing to do. And so he reached out to me about a year and a half ago and said, hey, could we do something together here? And he's just been a great partner. He's a heck of an advocate for real working people. And I think this partnership is an extension of that. And it launched today. So I'm hearing that it's selling like crazy. You can go to the Underdog site and buy it and support his foundation. But it's early. So we're looking forward to a lot of good stuff to come.
Byron, thanks a lot. Appreciate it.
Thank you.
The NFL draft kicking off tonight in Green Bay, Wisconsin. And ever since the event began rotating cities in 2015, it's provided an economic boost to wherever it may be taking place. The Greater Green Bay Chamber estimates the state of Wisconsin will take in over $100 million in economic activity. And in an interview with ESPN, president of the Chicago Federal Reserve, Austin Goolsbee, called it a real shot in the arm for a small town like Green Bay. Joining us now to discuss the impact and how the city's actually selected is Joe Pompliano, Yahoo Finance sports report host. host. Joe, it's good to see you. It's not too often I'm quoting Austin Goolsbee about sports rather than the Federal Reserve and the U.S. economy, so that's fun, a little worlds colliding moment here. But let's start with how they select the rotation, sort of what's behind that.
Yeah, that just tells you how big the business behind the NFL has really become over the last few years. But it's sort of an interesting story because if you think about the NFL, they have historically used the Super Bowl as a bargaining chip to get cities and teams to build new stadiums, right? If you build a new stadium, we'll give you the Super Bowl, which comes with hundreds of millions of dollars in economic impact. But a few years ago, a decade ago, really, Roger Goodell and the NFL realized that they could do this same thing with the draft because there's a number of cities, roughly half the league, that will never get the chance to host a Super Bowl because they're either in too cold of weather climate, they don't have a dome stadium, they don't have enough hotel rooms, the airport is too small. There's a variety of reasons, but those cities can host the NFL draft. And Green Bay is the perfect example of this. Green Bay has spent the last decade trying to get the NFL draft. This started with what they call interest surveys, which are essentially just these 3-page surveys indicating that you want to host the NFL draft. Then it becomes full-on bid proposals, which are 30-page proposals. That includes all the typical stuff like how you're going to accommodate flights and parking and hotels and things like that. But it also includes a whole host of other things like investments in real estate, where Green Bay has invested over $100 million building an entertainment district around their stadium a decade ago. Plus, they also built this 125,000 square foot expo center, which will be used this weekend. So the NFL is now intelligently using this asset that is the NFL draft. Rather than only hosting it in New York at Radio City Music Hall, they're taking it on the road and having teams bid on it by leveraging real estate projects, new stadiums, et cetera.
And when we talk about Green Bay specifically here, it's one of those smaller places that you're talking about. So how does a place that isn't as big, right, sort of prepare for this event happening?
Yeah, I mean, that was the big concern, right? If you think about Green Bay, they have 5,000 hotel rooms. Virtually half of those are going to be taken by media members and NFL personnel. So you only left with 2,500. Now, there are a little bit in the surrounding areas called another 5,000, but that's within an hour's drive. Now, the good thing about geography with them is that there's a bunch of other bigger cities located. So it's going to be more of a drive-in situation for most fans. Tickets are free, so there's not a huge price barrier there if you're able to just drive in for the day. But Green Bay is also doing a lot of other things, too. If you look at what happens on game day there, the residents of the town are super accommodating. They let people park in their driveways. They rent out their houses. So that's going to be another big thing there. They've established ride zone areas to accommodate a bunch of fans that are going to be busing in. The local schools are closed, so the roads can be open to the NFL draft specifically. A lot of the local businesses have already partnered with the NFL and guaranteed them some sort of revenue sharing by partnering with them and getting licensing deals. So there's a lot of different things that are happening on the ground, but this has been in the works for the last year. I mean, there's everything from the city has to provide the NFL with free medical and emergency services to tax breaks and things like that too. So this is all hands on deck from the state to the local level, all the way down to the Green Bay Packers specifically, that are aiding the NFL and making sure that this is a great event.
Wow, school closed for the NFL draft. That is pretty amazing, Joe. Thank you.
Thank you.
And be sure to scan the QR code below so you can stay up to date with the latest episodes of the Yahoo Finance Sports Report. It drops every Thursday at 5 p.m. Eastern. Well, Alphabet and Intel reporting first quarter earnings just a bit ago. Joining us with some takeaways, Yahoo Finance tech editor Dan Howley. Hey, Dan, where do you want to start?
Let's start with the bad news first, and then we'll go with the good news, right? The bad news is Intel. Obviously, they beat on the top and bottom line. Good for them. Now the bad news. We'll give it a compliment sandwich here, right? One of the bad news is the weak second quarter guidance. They estimate between 11.2 and 12.4 billion for the second quarter. Wall Street was looking for 12.8 billion. So big swing and a miss there. The CFO, David Zisner, basically saying the current macro environment is creating elevated uncertainty across the industry, which is reflected in our outlook. Now, there is some interesting news here. We'll go with that compliment sandwich. Now, here's the good stuff. Foundry did better than expected. The Foundry for Q1 brought in, 4.6 billion. Analysts were expecting 4.3 billion. Data center revenue also came in better, 4.1 billion versus 2.9 billion. And they beat on the client computing side, which is sales of laptops, desktops. Here's the bad news now. That beat, that 7.6 billion for for client computing versus the expectation of 6.9 billion. The thing there could be that people started buying up new computers just before the tariff deadline. And so that means the second half of the year, it might be, not exactly bupkis, but, not great.
Right.
And so, that's the outlook for Q2. That kind of helps to drive that. And then what's that going to mean for 3 and 4? Obviously, this is a company that's trying to reinvent itself. Lip Bhutan, the new CEO, has said, look, made mistakes. We're going to try to fix things. They're cutting on CapEx. They're going to lower headcount. And they said they're going to kind of squash some of the management levels to kind of even things out, they say. And then, obviously, Alphabet. Good news, basically.
Yeah, and they also had a big buyback, which maybe we didn't talk enough about earlier, but they did have that, as well as beating numbers.
$70 billion stock buyback authorization. They've raised their dividend by 5%, beat on the top and bottom line. I think one of the things, let's go with that compliment sandwich idea again. One of the negatives here is that cloud actually missed by a hair, 12.2 billion versus expectations of 12.3 billion, but advertising came in at 66.8, higher than 66.4. And we had also seen, obviously, EPS beat. It's basically a company that everybody's wondering what's going to happen with data center sales going forward. Are companies going to start to pull back now? Q1, obviously, no one was really thinking about that. I mean, I'm sure it was on people's minds, but it's not as reflective as what we saw with Intel, with that big kind of, everybody going out and buying up all the laptops, kind of like toilet paper during the pandemic. But this is, this could be reflective later on as we start to see, okay, people started cutting as tariffs came out. Now we'll see it in, Q2, Q3, Q4. It's still up in the air. Who knows what's going to happen with tariffs? I feel like every few seconds it's, on, off, on, off, on, off. It's Ross and Rachel, right? Right now they're on a break, I guess. So we'll have to see what happens in the next few quarters, though. But for Google, good stuff all around.
The tariffs are Ross and Rachel.
Yeah, that was off the dome, right?
That was pretty good. Thank you for that, Dan Hellie. That was pretty good. Thank you so much. Appreciate it. Let's take a look at what's trending after hours right now. Skechers shares dropping, sinking after the footwear company announced it's not providing financial guidance, withdrawing its previous annual outlook due to macroeconomic uncertainty stemming from global trade policies. Skechers also reported first quarter sales that missed Wall Street's expectations. Boyd Gaming delivering a beat on earnings for its first quarter. Net revenue also topping Wall Street's expectations. The company noting that while economic uncertainty has increased, Boyd Gaming is encouraged that trends in its business have remained consistent. And T-Mobile reporting a beat on earnings for its first quarter. The company, however, missing estimates on new mobile phone subscribers. T-Mobile lowering its core adjusted EBITDA and adjusted free cash flow outlook for the full year. Yahoo Finance's executive editor Brian Sozzi will be speaking with CEO Mike Sievert about the results. You can catch that interview at yahoofinance.com. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.